Gold has always been the safe haven asset, but what happens when you try to squeeze income out of it? Can an income focused gold ETF hold up? Well, today we're going to find out. Fasten your seatbelts, folks. This is going to be a good one. Gold has been a cornerstone of wealth preservation for, well, centuries, providing investors a safe haven during inflation, recession, and overall market turbulence. That that sounds a wee bit familiar, guys. Traditionally, gold does preserve wealth, but it doesn't pay you anything. No dividends, no distributions, just that golden price movement, usually to the upside. Covered call strategies are very good at creating income out of, well, non-paying assets and wrapping them up in a simple to use ETF. Well, that is exactly what Global X did with their Gold Producer Equity Covered Call ETF. GLCC provides you with some very good exposure to some of the largest North American gold producers. This includes companies like Anglo Gold, Kinross Gold, Barrick Mining, and one of my favorites, London Gold. But here's the question. Does adding covered calls and income generation on top of gold producers give investors a better overall return, or well, does it weigh down performance compared to a traditional gold ETF? I selected a similar non-covered call ETF to use as our benchmark. So the iShares S&P TSX Global Gold Index ETF, ticker XGD. While it's a little bit more global in nature, they do hold many of the same companies as GLCC. So, for comparison's sake, it does make a very solid benchmark. A sub to the channel is a golden ticket to future content. In a moment, we will take a look under the hood of GLCC. But before we do, I want to touch on a common theme when it comes to covered calls, and that's the loss of upside potential. So with GLCC, there is a trade-off for that income. And yes, it is a loss of upside potential. With a covered call strategy, you're collecting steady income. But if those gold producers suddenly surge higher, part of that upside gets capped because those call options are exercised. In other words, you're trading away some of the explosive growth potential for a more predictable cash flow. Now, I want to add this. I'm going to add this here as a point of interest, and that is that BMO has released ZWGD a few months ago. So that's a covered call spread ETF that, well, it is designed to help mitigate some of the losses of upside potential, but it's brand spanking new. So we'll have to wait to see if their new spread strategy is effective. So what is that spread strategy? In a nutshell, they're writing covered calls and buying options as well for when the price surges. Thus hopefully recouping some of the loss of upside potential. If that is something you are interested in, it is definitely worth a good look at for sure. In the meantime, let's focus back on GLCC. For those of you who like to play along with the math, the data points we are using today come from the market opening values from September 17th, 2025, September 20th, 2024, and September 19th, 2022. So, without any further ado, let's do this. Okay, let's start with that surface data. Their current value at the time of recording, $45.71. They have an NAV of $46.27. Those net assets under management, 455.29 million. And according to Yahoo Finance, their average volume coming in at 27,822. Looking at the fees, they have a management fee of 0.65%, management expense ratio 0.79%, and they do have a trading expense ratio as well of 0.38%. So when all is said and done, you're paying a little over 1% on fees for this ETF. When it comes to fund specifics, really we already kind of talked about the companies that they already hold. But let's talk a tiny bit about their geographic diversification. This is mostly Canadian. We're looking 75.56%. The United Kingdom, 8.76%. The US, 7.95%. And South Africa, 7.95%. They got a good amount of gold in South Africa. They're a little more global than we originally thought going into this. So that makes XGD even a more better benchmark for sure. Okay, looking at their dividend, they have an annualized yield of 7.26%. That's a monthly dividend, 28 cents per share. Not too shabby. On to their returns. Their 3-year return on investment, that comes in at a nice looking 119.97%. Factor in those dividends, total return 159.23%. On their 1-year, that return on investment 56.81%, adding in the dividends, total return 66.79%. That gives us a 3-year annualized of 37.37%. Okay, those look great. I have no complaints about those numbers. Okay, this is fantastic. Now let's switch gears and see how well they did against our benchmark XGD. So in terms of their 3-year total returns, we already saw GLCC had 159.23%. Well, and this is where we're going to see that loss of upside potential. XGD 190.43%. Holy banana bread. That is pretty significant. I will absolutely say. Now, mind you, gold, with the way gold has been surging, it's kind of expected. Maybe the 1-year looks a little better. We'll take a look. 1-year total return. So for GLCC, 66.79%. XGD, 73.86%. So from this, yes, we can clearly see that loss of upside, and that is the price you pay for the instant income in your pocket. I would add though, if you did reinvest the dividends, the gap does close a wee bit for sure. For example, if you reinvested on the 1-year time frame for GLCC, you would raise that total return up to about 71%. Okay, I think it is time to wrap this all up. Maybe a fancy bow, maybe not. It's hard to say. So back to the big questions. Can you really squeeze income out of gold? And can an income-focused gold ETF hold up? Well, the answer to that is yes, but it does come with a caveat. GLCC does deliver solid, reliable income, and for investors who want that steady cash flow, it is a very strong option for sure. But of course, that trade-off is clear. If gold stocks go on a tear like they have been this year, you're not going to capture that full upside the way you would with a pure play ETF like XGD. You can get closer if you reinvest those dividends, but you still fall a wee bit short for sure. So here's my say on this, my final verdict, I guess. I guess that's what we used to call it. If your style leans towards income and if you want gold exposure paying you along the way, GLCC deserves a spot on your radar. However, if you're chasing maximum growth from gold producers, the benchmark ETF is then, well, XGD, without a doubt, the better fit. If you are interested in any of the ETFs that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Utes versus UMAX. Thank you for watching, and I will see you in the next video.